is there like a fundamental reason why me, you, and Fred and other trend followers pick this approach over others? Because you can't actually say that all of these other approaches don't make money or can't make money. So what is the fundamental reason to put yourself in this camp that we've put ourselves in?
I think the fundamental reason is that we're after long-term sustainable wealth building returns. And to achieve that, we need a system that stands up in a broad array of different market conditions and slowly but progressively we work on this edge that's in our system, and the power of compounding over the long term builds these fantastic long-term wealth building returns. That's sort of different to the predictive trader who, yes, we recognise there is arbitrage to be taken in predictive methods, but it's fleeting, it's short term, and therefore, while they might have a quick hiatus in the sun while that condition exists, there's an opportunity cost when those conditions finish and they're searching for the next predictable condition. So they're not in the market during those times, or worse still, they're in the market applying their prior successful predictive technique, and now they're getting big drawdowns and they're thinking, will this go to risk of ruin? Because they're trading what I regard as a non-robust trading system, there's always an issue arising from not knowing whether they are in a natural drawdown or whether they are approaching risk of ruin. And so this finite shelf life that they have, to be successful in the long term with wealth building returns, you don't just have to be successful over one predictive condition. You've got to be successful over a long-term vast array of different predictive conditions, and that's where they're unlikely to be successful over the long term, because you've got to strategy hop and you've got to find what that predictive condition is, and it's got to be a durable predictive condition and not something that changes immediately as soon as they get onto it. So there's a cost to them in the strategies of, whilst they get a successful, nice linear equity curve when they're right, it's all the times they're either wrong or trying to search for another strategy or whatever, that either they have no trade activity or they've got a horribly declining equity curve. And so that doesn't assist in building this long-term sustainable edge or long-term wealth building returns, which relies on almost the Pareto principle, where that small edge over a long time compounds to produce a non-linear huge wealth pot. So
I know. I mean, it's a difficult concept to take on board, because essentially you're saying, look, it is possible to make huge returns in the short term, but that's a much less reliable approach. And you really kind of have to go back to square one with all of this, don't you? And say, look, what am I trying to get out of trading? What are my goals from trading? And, most of us are trying to essentially turn a small account into a large account, aren't we? And larger, the better. And it's very difficult to kind of turn away from approaches that appear to have the greatest short-term returns, and adopt an approach that where the returns probably aren't so spectacular, but when you apply compound into it over, we say a long term, but what we talk, I mean, even say more than 5 years, but we say like 10 years, it's a reasonable term. So we're looking for a more reliable outcome. Would you say that was true?
I'd say that's definitely right. I think for the likes of those long-term traders who've been in the game a long time, like yourself and me, we love the game. We love the game, but we've recognised with the school of hard knocks over the course of time that the game can't be won in a few months or a year or whatever. The game, to stay gainfully employed in this game, we want to stay in it for the next 20 years for our lives because we love this sport. So we've got to therefore change our mindset from one of instant gratification and immediate reward, because there's risk embedded in that assumption. And we've got to take a much more conservative outlook that we apply a simple technique with a durable edge, and we are patient and are prepared to hold on to these drawdowns, because we're always in drawdown almost all the time, but that is just a natural feature of our system. But see, that goes against the grain mentally from everything that is conditioned in our brains. We want everything now, immediate gratification. We want to be right with our trade wins. So we want a system that gives us a 90% correct win rate. We forget the important other side of the expectancy equation, which is the reward to risk relationship. And so we just want this immediate wins. We're right all the time. Our brains like to be right. Trading this other way, which is learnt from the school of hard knocks for the long-term traders who want to stay in this game a long time, they really need to flip that mindset, because what we do is incredibly psychologically difficult, but it is incredibly long-term rewarding.
Yeah. And, you talk about the difference between predictive approaches and price following approaches. But there is actually more to it than that, isn't there? So for example, I had a thread on Forex Factory last year where I just traded a simple price following approach. And it was just a single strategy, and it generated good returns, and all the evidence in back testing suggested it had legs going forward as well. But we even using the trend following approaches with a single strategy, there's too much dispersion in the returns with that, and that's why we kind of really drive this diversification point home as well.
Yes, definitely, mate. So imagine that single system that you were trading. It was a good system. You saw the rewards in it. However, what you noted from that system is that you might have been spectacularly successful one year, but then for the next 3 years, you might have had ordinary or below average returns, drawdowns building, and then another year pops up and you're spectacularly successful. Now, while the system itself shows that there is a long-term edge in it, because over the course of a 10, 20-year look back, you see that there is positive expectancy in that system, the nature of those returns are sporadic. They're not continuous throughout. So as a portfolio, as a price follower, you need lots of those different systems, because the idea is that the spectacular win months of one particular system will be offset by ordinary months from other systems. But when you collectively put them all together, you find that at the portfolio level, you start to see that nice linear line of ascent in your overall equity curve. But that is actually, if you look at the individual systems within it, they've all got that very step nature. They've all got volatility in them. But you don't see that at the global portfolio level when you're heavily diversified. So what happens is, for a trader who's a predictive trader who does mean reversion, who's after a single system offering that linear equity curve, all of their efforts are concentrated in that one system. It's a concentrated strategy. They actually get no benefit from diversifying, because a predictive assumption is based on the principle that they know where price is going to go in the future. And so based on that assumption, with a mean reverting method or whatever, you have a price target or a profit target. And so it's a defined outcome in the future that is predicted. Or a fundamental investor believes that a stock is undervalued at this point in time, but he's got an intrinsic value in his mind. It's a forward prediction of where price should be, and therefore he makes a concentrated bet as to where that's going to go. Those models do not work with diversification. But with our price following techniques, where we get this step nature over the course of time, where our wins are much more sporadic, unpredictable in nature, you need a diversified method that adds a lot of those different return streams together of different systems with different signatures and volatility in them to achieve this linear line at the portfolio level. And that linear line means that you have this continuous growth in your wealth over the course of time, and you have low drawdowns because that composite of systems you've got in that portfolio, you're risk managing all of those collection of systems by offsetting drawdowns. So we win in so many different regards by being diversified and price following. You can't really be a price follower and not diversified, because otherwise it's going to be a long wait between drinks or celebrations, because you never know when you're going to get those nice lifts in your equity curve, and you never know how long you're going to be in drawdown for. But at the portfolio level, that's all managed through a huge diverse array of markets, systems and timeframes that manage to flatten that entire sort of unknowns. It flattens it, and you get this great slow building wealth pie.
Yeah, and it kind of opens doors to looking at the individual strategies differently, doesn't it? Once you take on this idea of a diversified portfolio, you realize that, I mean, when you have a single strategy, then you kind of need to make it trade frequently, don't you? Because I mean, if you're sitting there for 6 months and the market's moving and you're not trading with your single strategy, then you're kind of, well, you're not going to make any money by not taking any trades. But when you've got a very diversified portfolio of strategies that are looking for different market, particular market conditions to trade, then it actually alters your approach to designing the strategies as well.
Absolutely, mate. So when you trade a diversified portfolio, you've got the luxury of trading seldomly on any particular market, system or time frame. And that seldom trading philosophy means that you only take the best opportunities. So if you are trading a single system and reliant on that for cash flow or wealth building returns over time, you want it to be trading frequently to meet those demands. And that's an expectation of yourself as opposed to what the market delivers. Yeah. So that's where that tends to fall down. But under a diversified portfolio, each individual system component actually will have a low trade frequency, but where you increase your trade frequency is through your diversification across hundreds or even thousands of different return streams, which collectively add up to a big sample size.
Yeah.
So that therefore, totally accommodates it.
Yeah, that was a real aha moment for me when I started working with you and Fred. Was it meant that I was always trying to force trades in the noise and always be in the market because, obviously on a subconscious level, I was noticing that there isn't actually many trends in a year. Say on a 4-hour chart, you maybe have 4 in a year. And so I was trying to generate trends out of the noise.
Yeah. No, I know, mate. I've been there. I've been there, done that.
And as we saw last year, you can actually make really good returns with that. But the problem always is that, very large drawdowns are just around the corner. And when you just look at return, well, okay, I made 50R or 50% last year, then and you ignore those large drawdowns, you can make some wrong assumptions. But when you start thinking in terms of comparing your biggest drawdown to essentially your total returns, you start to realize that essentially what you're doing is you're just paying to play a lot of the time, which is fine whilst you're making money, but somewhere down the line there's going to come an occasion where you lose the last 3 years profits. And talking about that, when you look at a 10-year back test, say, okay, well, in the middle there I had a bit of a dip, that was fine. When you're sitting there for 3 years and your account balance is slowly dripping away, the psychological effects of that are pretty, so we're also in effect trying to make it easier psychologically. So you're not going to make, when the bad times do come along, you're not going to make a really bad decision or choice. We don't have to do that because we're so well diversified that the possibility of a catastrophic drawdown is greatly reduced. You can never get rid of it, but we're trying to sit in that comfortable place, aren't we?
Exactly. Like the aha moment for me was that I used to invest all my efforts in single systems, and I used to think that was the means to the end. And I was talking to other retail traders, trying their systems. Things would work for a couple of years, then things wouldn't work, and I was just spinning my wheels over the course of time, not getting anywhere. So the aha moment for me came to the fact that it's actually the systems are the means to the end. They're not. What actually is the end is the portfolio. So it's at the portfolio level that all the heavy lifting is done, and the systems are just individual contributors to that overall result. And when you play at the portfolio level under diversification, you've got well-worn techniques you can apply by the professional FMs that make the game so much easier. And so what you then can do is go back to some of those very simple systems that you liked but never actually stood up because your demands were placed on you want everything with a single system. So these simple systems like Donchian breakouts, simple moving average crossovers, all of those things, which you understood and you thought, oh yeah, they're okay. But when you tried them as a single system, they never held much weight. There was lots of drawdowns and very low returns over the long term. So how the hell do these guys make money out of them? And then it suddenly dawns on you that you can actually use those simple system ingredients. But the secret sauce lies in how you compile them together at the portfolio level to manage your risk, to deal with any correlations between your systems, and to produce these stunning, almost managed equity curves. So I had a big session reading. One of my favourite authors is Andreas Klenow, and his book, Diversified Trend Following. When you step through that book, there's places in his book where he starts mimicking the return streams of the professional FMs, like Mulvaney Capital, like Dunn Capital, like all of the big successful long-term price-following firms. He was able to mimic them with his selection of universe and his selection of systems, and his equity curves could almost exactly mimic theirs. And I thought, what a stunning ability. And I thought, what is this secret sauce he has in there where he can actually manipulate his equity curve? Because prior to reading his book, I was in the case of, well, the equity curve is a result of all of the trades I've taken. You can't manipulate it. It is what it is.
Yeah.
But in this case, you could actually manipulate it. And I thought, what is he doing to do that? And that actually occurs at the portfolio level. And that's where I think a lot of retail traders miss out, because they simply aren't aware of the techniques and how easy it is to actually manipulate your overall equity curve at the portfolio level within managed drawdown and risk constraints. And that was a big aha moment for me.
Why the interesting thing for me was is the fact that using a portfolio is really common amongst the pros, but there's hardly any mention of it in the retail space at all. Diversification comes up now and then, but we never see a great deal of interest from the retail world. Why do you think that is?
Well, the only times I see something almost resembling portfolio management is where you'll hear in the retail traders world, they talk about baskets of currencies or baskets of instruments which they trade. They don't actually use the term portfolio, but I think it's because the traditional world of portfolio management has been highly mathematical, and when you start getting into the modern portfolio theory, and you start talking about the efficient frontier and Markowitz and all of those things, you're suddenly slammed in the head with this intense mathematics, and so you lose interest quickly. So you think, well, I don't really have expertise there. What can I do? But you'll actually find that they're the sort of theoretical aspects of portfolio management. There's actually just using visual techniques, ways to achieve that exact same outcome. And so the portfolio approach I look at is stuff that I'm capable of understanding. And so I'm a very visual person, and I don't like heavy mathematics, but I can describe that mathematics in visual terms. And when you look at, say, an equity curve, and you start putting 2 equity curves, 3 equity curves, 4 equity curves together, things that are mathematical, such as correlation statistics and things such as the drawdown and things like that, they are actually visually represented by how those equity curves superimpose on each other. So being a visual person, I do this mapping of the equity curves of my different systems to collectively achieve a desired result. And that's doing what the maths is doing, but in visual terms. So I think if traders could understand that, they would more likely be engaged in what portfolio management is, because they are seriously missing out on a big aspect of the secret sauce of where you get these long-term returns. And these visual techniques might be the way to do it.
Yeah, I mean, again, that was another light bulb moment when I started working with you guys. Was I always felt that the actual construction of a portfolio and the actual basic methodology of getting there for me was just a step too far. But when you showed me this visual approach, it was like, I totally get that. Why I was annoyed that I never thought of it myself, because it's just a brilliant solution to the problem. And I think that is the barrier, and the reason it's not talked about very often is it's quite a difficult concept to get over simply. And what we see in the retail world is we like things that are fairly simple, single line explanations, which is my gut feeling it's why things like price action and chart patterns are so popular, because it's a simple image, and it's very easy to connect a narrative to that, and so people are drawn to that, and I think that's the great thing that we're doing at ATS is we're trying to simplify this step. We're saying, look, we're all ignoring this, and it's probably because the information out there about it is a little bit hard to grasp. And we're saying, well, look, this is a way of simplifying the concept. It's still very eloquent what we're doing with the portfolios. They're not any less robust than what the professionals are doing, but it's just a slightly different methodology, isn't it?
Absolutely. And what retail traders will find, and a lot of retail traders specialize in trading in the Forex space or the CFD space or whatever, and they believe that when you look at a portfolio system, a portfolio of products in those particular universes, you realize that they could really get bigger bang for buck with their finite capital if they embrace some of these ideas. So, and with these visual techniques, I think that is the easy path. without having to go to college for 3 years to understand the mathematics of, modern portfolio management and theory. This is a way to easily jump on board, because the visual method is, if you can just click into gear what your equity curve is, which everyone's familiar with, then what happens when you place multiple equity curves together? It's quite a simple idea, and it's a bit like what you might have learnt back in the physics class at school, where you looked at wave functions and interference and destructive and constructive interference when you superimpose different waves together. And the same principle applies with equity curves, in that when you superimpose your equity curves, you get this destructive interference resulting in randomness being subdued, and you get the signals being amplified through constructive interference. So the diversification at the portfolio level actually produces these higher risk-adjusted returns, because it's actually engaging a physics principle of this destructive and constructive interference of your different volatility that lies in your equity curve. And so being a advocate of science and physics for a long period of time, I jumped on board this idea, and that's why these visual ideas came to me so easily, and why I thought this is another way of looking at it, as opposed to a financial calculation involving Markowitz's efficient frontier. I thought this is another way to deal with it. Let's have a look at how far we can progress with this, and so those visual techniques I believe are pretty unique to ATS. But they certainly, I challenge that they produce, as good or even better than some of the statistical methods. And an example there is if you use a correlation statistic, that doesn't tell you much information. That tells you how that particular return series is correlated to another return series. So you get a single statistic. But when you get an equity curve and you map it to another equity curve, you don't just get that single statistic. You can see the relationship along the entire data series of the relationship that exists between those two return streams. So at some periods of time, they might be correlated. At other periods of time, they might be uncorrelated. Now, for a trend follower who wants to benefit from positive correlation during beneficial times, but also avoid being positively correlated during adverse times, that relationship using the mapping process actually gives a little extra secret sauce than what can be delivered by a single statistic. So that's why these visual methods are so important, and I think are pretty powerful.
Yeah. You use this phrase bang for buck a lot. Can you explain simply what you mean by that?
So what I mean there is that let's say in the traditional retail world, they might have heard a mantra that only risk 2% of your trade capital.
Yeah.
And so what they'll do, without necessarily testing that assumption, they'll adopt that mantra and they'll say 2%, that's all I'll ever risk. Yeah. They don't really draw a conclusion based on a test result that comes to that idea. So what I'm saying is that when you operate at a portfolio level, everyone has a finite capital amount that they trade with. But when you use a portfolio, you can actually optimize the most efficient means of use of your finite capital. So at the portfolio, that typically means that you're operating in a zone well above 2% trade risk, but your overall risk-adjusted returns are far lower than what you'd achieve if you're just simply adopting that mantra of 2% trade equity. It's almost it's contrary to the mindset how that occurs, but that's because at the portfolio level, you're managing the return streams and the correlations that exist in your array of different systems at all points in time. Whereas if you apply this single 2% statistic, the assumption is that you've got 98% of your trade capital just sitting there idle. I mean,
yeah. So
it's not the most efficient way of using your finite capital. You want to engage as much of that capital as possible in some technique that has a positive edge. That way, your wealth building returns are accelerated far faster than what a trader adopting that mantra would.
So it's would you say it's being more efficient with your position sizing, basically?
Yes. So this mantra, this 2%, is basically the rationale for that logic is that you only risk a small amount per trade, and 2% is the amount. But actually, that is far too high. Per trade, it should be something like 0.05 or 0.25% of your trade equity. But anyway, irrespective of that, when you but if you trade a bundle like 50, 100, 1,000 systems, all of those 0.25% add up. And so you're effectively trading at any given instance far more than 2% of your trade equity. But a single system trader who's risking 2% of equity might have $10,000 sitting there idle, or $8,000 sitting there idle, and is only trading 2,000 with it. But a portfolio manager who might have $10,000 might be actively trading with 60% of his capital, but it is all risk managed. And that's the thing. The emphasis should be on risk management, because whilst you might, using a portfolio, that the secret sauce doesn't lie in increasing your overall returns, it actually lies in reducing your risk management exposure, or your volatility of your returns. When you reduce that volatility of returns and you get a straighter linear equity curve, then you can apply position sizing above and beyond what the retail trader's 2% is telling him to maybe 5%, 10%, and know full well that it's been risk managed all the way, and you get a much more efficient use of that finite capital.
Yeah. Cool, Rich. Well, great chatting with you today, mate.
Thanks, Darren.
Thanks for coming. If any of the listeners want to ask any questions for me to pose to Rich on the next podcast, then leave them below, and just any feedback on the recording today, we'd love to hear your comments.
Thanks very much, Darren. Thanks, guys.